Hey guys. All content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. So be honest, who in their right mind really thought markets were going to be popping up today? I saw some bulls seemingly out of touch hype a market comeback this Friday, only to be met with the reality check that the perma-bull psychology of markets always bouncing up is defeated. Some important key developments took place today that will have weight into how markets behave and pan out in the coming months for next year. The big news today was Russia saying the annexation of Ukraine will last forever. Vladimir Putin vowed his annexation of 4 occupied regions in Ukraine is irreversible. This was the biggest land grab since World War II. He also demanded Ukraine stop fighting and to begin talking, threatening he will use all means available to defend their lands. The UN denounced the annexation as illegal, with Ukrainian President Zelensky condemning it, claiming that dialogue with the Russian president is impossible. More sanctions were passed by the US as well. Ukraine formally applied to join NATO today, but the alliance responded with immediate caution. The disparity in how both nations look at the conflicts and stance of one another suggests that none are willing to reach peaceful resolutions, which imply the war for Ukraine will last through the rest of the year in 2023 for the foreseeable future, which simultaneously means markets are to remain bearish into 2023. In fact, if the war efforts intensify and Russia gets desperate, they might retaliate by toying with the energy exportation to Europe that they provide. This could add further uncertainty, unrest, and break entire economies not just in Europe, but the rest of the world. It was an incredibly bleak development for the world and economies, and feels even worse with Russia blackmailing the world with nuclear threats if they don't give them whatever Putin wants. An interesting opinion piece was published by Coppola Comment today. Titled "What was the real reason for the Bank of England's gilt market intervention?" Francis Coppola asserts that the bank does not have any mandates to prevent pension funds from going bust and that the type of pension fund that got into trouble isn't at meaningful risk of insolvency, therefore implying there was never any risk of people's pensions. The bank was not concerned about pension funds at all, which begs the question, what did the bank have in its sights then when it decided to intervene? But for us to understand this, let's recap the sequence of events that happened. Pension funds sold assets to raise cash to meet margin calls on interest rate swaps. The sudden influx of long gilts onto a market already scared by bad government policy announcement caused their price to crash, which was what made the headlines. At one point, there were literally no buyers at all. The crashing price severely damaged the asset side of defined benefit pension funds. Had these been normal companies, they would have gone absolvent. But these were defined benefit pension funds, which aren't normal companies. They are the management of their sponsoring employers. So long as the employer is solvent, the defined benefit pension fund can continue running with deficit. This means that the excuses put up that pension funds were insolvent missed the point, because they were never at any risk, and data shows that they were extremely liquid. Yet the Bank of England still came to intervene, so why was this? They came in rushing as buyers last minute, signaling they would buy $65 billion over the next couple of weeks. This injected liquidity into the market. The reason for this wasn't to ensure solvency, but rather intended to head off the threat of a full-on systematic meltdown. Pension funds hedge the difference between assets and liabilities with interest rate swaps. They have fixed liabilities, variable assets. So what type of institution have floating rate short-term liabilities but longer-term fixed-rate assets? The banks. You see, the corporate media has been loud about pushing the narrative that England came to save pension funds, but really what they came in to save were the banks. The market freeze created a cash collateral shortfall and banks were put at risk of serious losses on derivatives. This is what the Bank of England feared, and it's what they came in to save. It's never about pension funds for the hard workers of a country, it's always about saving the banks and private interests of the rich. This was absolutely disgusting to learn, and big shout out to Coppola Comment for putting things together. On another set of news, Barclays hit $361 million in penalties over issuance of securities. The conduct concern dates back to March of this year when Barclays disclosed that they had accidentally oversold complex structured and exchange-traded notes, overshooting by a whole 75% a $20.8 billion limit on such sales. The real question is how much money they made or saved while outright violating these regulations. According to different sources, Barclays is also now open to litigation, so we shall see how this evolves. It was a brutal day in terms of news for the economy overall, and markets reacted negatively to them for the first time, as they should. I will make this video short and cut it off right here. I wish you all an amazing weekend. I will probably see you on Sunday, and if not, then on Monday for sure. Until then, I hope you guys have a fantastic rest of your day and to the moon.